Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to another episode of The Wealth Flow. I'm very excited about our next guest, Lane Kawaoka with Simple Passive Cash Flow. Lane currently owns 10,000 plus units across the U.S. He lives in Hawaii and recently quit his day job as a professional engineer. He's got a master's in civil engineering and construction management and a BS in industrial engineering. Lane partners with investors who want to build their portfolio but are too busy to mess with tenants, toilets, and termites by curating opportunities with his Way Deal Pipeline Club, where his investors have personal access to him and know that Lane personally puts his money on the line as well. The Pipeline Club has acquired $2.1 billion of real estate by syndicating $186 million of private equity since 2016. And Lane has one of the top 10 investing podcasts, Simple Passive Cash Flow. Lane's mission is to help hardworking professionals out of the rat race, one free strategy call at a time. So Lane, welcome to the show.
Hey, thanks for having me, Keith. Aloha, everybody.
Yeah, aloha. What time is it there in Hawaii? I'm in San Antonio. It's 3:30 here. So
yeah, we just started the day. I just got back from the gym. Kind of start the engine up.
There you go.
So you guys are a little done now sending me.
Yeah, pretty much it. 3:30 on a Friday.
Now I can get stuff done.
Yeah. There you go. Sounds good. I think maybe if we could start with your background, obviously an amazing background. I actually started in civil engineering as well. I ended up switching majors, but was doing architecture and civil engineering. So neat to see that in your background and you having a master's. But if you could maybe give us just a little bit of background on kind of you growing up and kind of eventually what got you into real estate.
Yeah, I mean, I think I call this the linear path story. You know, I was kind of taught to go to school, study hard, work at a job for 40, 50 years, putting your money into a 401k, mutual funds, and then buy a house along the way and have 2.1 kids, blah, 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 blah.
Yeah, exactly.
I maybe you did this too, but like when I was in high school, I was super lazy and I was like, well, what's the most amount of money I can make with the least amount of school in a college? And that was an engineer, right? So I kind of went in not knowing what the heck an engineering does and how kind of boring and, role it is. But I went through 4 years of college, got that engineering degree and started to work for the man. I was never really good engineer. So what do? You go to product management and it's like, project management, right? So I was managing all these these crews. And like first day I was like, this sucks, right? Like how much more do I have to do this? Luckily, I was really good with my money. And, even in college, I was like watching they didn't really have YouTube back then, but like all the personal finance blogs back then. And, I was saving my money to buy a house to live in as I was kind of maxing out my 401k and all those index funds. And, fast forward a couple of years later of saving my professional salary up to buy a house. I was living in that house and I realized what a waste it was because I was only home like one day a week, kind of travel because I was traveling all over for work. And that was kind of where it all started. I got that taste of cash flow. I was like, wow, this is really cool. The tenant's paying down the mortgage and, I'm getting like a few $100 of passive cash flow. And I was like, wow, I got to keep doing this again. And in the beginning, it was cool beer money for a young 20-year-old kid at the time.
That's right.
But I was like, wow, if I just did this a handful of more times, I'll be able to quit my job and, escape this rat race, right?
Absolutely. No, that's great. So when you say you had tenants paying, were you house hacking? I guess now they term it, but had just had roommates that were paying you to live at your place, or?
Yeah, I mean, this was back in like 2009, 2010. I didn't have any of that type of stuff. I just called up an old property manager and then, got a tenant in there, moved all my crap out and started to just live on the road, in hotels that the company put me up in. So for like several years there, I was like banking my entire paycheck. So, over $100,000 a year was kind of going to buying more and more of these rental properties. But, for people getting into this world of rental properties, it's not that hard. I didn't really know I didn't know anything. I mean, there's like a 50% rule and rent to value ratios. Like I didn't know any of this. This first property was in Seattle, Washington, which isn't the best place to invest for cash flow. But, I just kind of bought more and more from there. And I think the aha moment came pretty quickly where I was like, I'm making money 4 ways with cash flow, appreciation, tax benefits. And I can't remember the last one. I don't know. My net worth is high now because of it, whatever it is. It worked. And I was like, wow, I'm making like 20, 30% returns on my money. Why the hell would I want to put my money in this 401k nonsense? That everybody else did. And then I started to realize, I took the red pill of finance and I realized, wow, like all these retail traditional investments, there's a lot of middlemen in there. Even if you get around the financial planners and just go with a robo fund, like you're going to these traditional investments and at the very least, you're not getting the tax benefits of the real estate.
No, it's a great point. Great point for sure. And so from there, what did you invest in? Just are these primarily single family homes that you're getting started with? Yeah. Yeah.
So I initially started to invest like where in my backyard because I didn't know any better. And I think most investors are pretty uncomfortable going outside where they live. For some reason, people want to feel it, touch it. Makes sense, right? And that's what I did initially. So I bought that first house in Seattle. Then I bought a duplex in Seattle in a little bit rougher area because I was a little bit more cognizant of this whole, you don't want to buy properties in the nice areas because your rent to value ratios aren't going to be good. Of course, you don't want to go to the low end because then you just deal with a lot of delinquency and bad tenants and it's unsafe there. So I kind of caught onto that. But then this was around maybe 2012 was when I bought my next rental property. And I realized like, hey, there's these turnkey rentals out there that I think, people still do it. The numbers don't make as much sense today as it did in 2012 to 2015. But through this time, I bought 11 of those funny things and it was working. I think I bought like 5 in Atlanta, 4 in Birmingham, and then 1 in Indianapolis and Pennsylvania. And it was working, it was good at the time, right? And I think it works really well for people who are getting started under $500,000 net worth. But then I kind of hit the growing pains there, around 2015, I started to realize, man, these are kind of a pain in the butt, to give people a little insight what it's like, with 11 rentals, you maybe have an eviction or 2 a year, some kind of big catastrophe that happens every quarter that kind of sets you back a bit. Like a tree falling on the house or some kind of rainstorm that floods out a basement, something like that.
For sure.
And of course, I'm a bit advocate for having property management because, especially if you're a working professional, you shouldn't be screwing around playing landlord. You hire professionals to do that for you and pay them the 10%, which is another reason why you need to invest outside of primary markets like Seattle, Hawaii, California, New York, stuff like that. But, I 11 rentals with a few $100s of cash flow from each, $3,000 a month. Not bad, right? For a young 20-something-year-old kid. But, today, most of my clients are looking for that $10,000 to even $25,000 of passive cash flow. So you're going to need to up that head count or unit count by like 3x, 4x, and then also increase that exception rate. So now you're dealing with like an eviction or two every other month, potentially, and catastrophes that happens almost every week. And that was when my aha moment happened, when I started to kind of meet other accredited investors. There are people who were, doctors, lawyers, engineers, professional sales guys who made, who are already making six figures, multiple six figures and above, and had been investing as long as me or even longer. And, something I kind of always look back is like, well, what is people's net worth, right? Net worth don't lie. Unless they, of course, they were born with it, of course, then don't listen to that guy at all. But, people follow what people do, right? Because they're typically doing the right things. And what all these guys were doing were, they had used rental properties to get themselves off the ground, or as I call it, in like this wealth elevator concept. The first floor and the basement is getting out of debt and, consumer debt, and then loading up in good debt and buying assets. But once you get above like maybe $500,000, or certainly when you are a accredited investor, making a couple $100,000 a year at your day job, then the little rental properties just aren't scalable. And at the end of the day, they're just high liability, just in case somebody trips or falls. And the syndications and private placements world got unfolded to me. Yeah. I was brought into the world of the country club deals.
There you go. Yeah, for maybe some folks that aren't familiar with the term accredited investor, can you kind of explain what that is for the audience?
I would love to, and I'm really rehearsed with this. Per the definition of the SEC, you can look it up on SEC.com because the definition will change from time to time. An individual that makes over $200,000 or $250,000 married is an investor, accredited investor based on income, or you have a net worth of over $1 million minus your primary residence. I don't really agree with that whole primary residence thing, but that is what it is. But there is no test. And most deals out there are 506B offerings, and it is a self-certify thing. Only deals that are out there that are mass marketed, which people typically see because they are mass marketed, those are actually rare. And those are the ones that you need to third party certify that accreditation status.
Yeah, makes sense. No, I think that's helpful to know. So that turned you on to when you started looking at syndications to invest in. Were you looking at multifamily, or what type of syndications?
Yeah, I mean, I think multifamily is kind of the gateway to a lot of this, and it helps if you know the business a little bit. Mm-hmm. A lot of passive investors, they invest in apartments without never having a rental property, and that's totally fine. At the end of the day, you're kind of investing alongside a more experienced sponsoring general partner. And, especially when the interests are aligned, right? As long as you don't work with dishonest people, you'll do pretty well. But yeah, I had rental property experience. So, what do? You go into apartments. And then you kind of unfold into this world and you meet other people and you realize that there's other different asset classes out there, like self-storage, mobile home parks, office, self-storage. The list goes on and on and on. I personally like the whole thesis of, workforce type of housing. It kind of goes along with, unfortunately, the rich are getting richer, the poor are getting poorer, the middle class are being shrunk down, and endangered species and becoming the lower middle class. And then, with immigration, always there and the population getting bigger, it's that lower middle class rung that is kind of the underserved, certainly of high demand for that, and, neutral to undersupply on that stuff. And that's kind of why I like to invest in that sector. But yeah, you get into this world of alternative investments and invest in all kinds of stuff, right?
For sure. So, and what are you currently? I mean, $2.1 billion in real estate. That's huge. What is that? What type of asset classes is that? Is that a combination of several different, or what is?
Yeah, I would say like 90% is multifamily apartments, but
Okay.
I mean, like it's the target has changed over the years. I mean, when we first started, we couldn't raise that much money. Like we were new, right? Nobody trusted us. So we went after like these little dinky 50 unit, 60 unit, 30 unit, class C multifamily in some rougher areas. And then, again, just like the same epiphany I had with the single family homes, dealing with lower end tenants is just a pain. And for passive investors, it's not your problem, right? That's exactly why you go into a syndication. But it is, from a passive investor's perspective, it is very, I don't want to say volatile, but cash flow and, it is a little sporadic, I would say. I mean, on the sponsor end, like, we had to deal with some properties consistently going, 20% non-collections, so that means,
oh, wow,
you got 100 people in there, you got 20% of the rents you never collect because you just got deadbeat tenants that just do partial pays or whatnot. So that got old really fast, right? And this is like early on in 2016. So we kind of tried to step up to nicer assets, more class B assets, still under that umbrella of workforce housing, just in case a recession came and, comes, right? I think it's kind of prudent because the whole theory of, you don't want to be in the high end luxury stuff because when times are tough, there's this cascading effect down. So the reason why you go to the class B and the C class is you catch those people on their way down. But when we went through the pandemic, obviously that didn't happen, right? The class A people were ineffective and the class B and C were hurt more, which also goes to show like, you never know what the heck is going to happen. There's always going to be some kind of black swan event that happens. And even in class, like I think the two hurdles, not only from like the pandemic, but eviction moratoriums. And, we realized over the years that, multifamily value add is great, but like it is, at the end of the day, you're dealing with tenants. And the analogy I like to use is kind of like you're in a Jeep and you're like going up and down on the bumps in the roads and you're feeling all these like big bump, like pandemic, interest rate hikes, like there's always things that's going to happen. Whether it's not one thing, it's the other. And we've always looked at like, myself as an operation company, we got past that $1 billion mark in 2020. And then we started to hire professionals to kind of run our assets on salary for us. I recognize that, I was not the best operator myself, right? I mean, my experiences in construction and engineering, I did not spend 10, 20 years as a property manager. And I think that's what a lot of people don't realize is just because you're a professional in one industry and you have a lot of good business skills, it does not directly apply to other industries. And, although property management is kind of a thankless profession, it's also one not to be discounted to, under that discussion. So when we went over $1 billion in assets, we started to hire out teams, people to come up from other private equity companies. And, we kind of built a team from there and scaled from there. But still we're in this Jeep, right? And we're like, well, where the heck are all these private equity companies that have been around for over a decade, or certainly since the Great Recession in 2008? And the truth is, and I've had several people tell me this with very high net worths who've been investing much more than a decade. And were before, all this syndication wave started to hit in 2020 and after, and then obviously hits the first page of the Wall Street Journal this past month. But, they say, these syndicators, what they eventually do is they go off to greener pastures, which is different asset classes, much more institutional asset classes, or they go into development. and they certainly get out of the multifamily value add space. And that's what we've been kind of doing these last couple of years. We kind of started the development arm of our company, and, it kind of allows myself to use my engineering background, managing contracts, or at the very least being able to hire young engineers that are more than happy to work super hard for $100 to few $100,000 a year.
Right.
To make us rich,
There you go.
The investors and operators and the principals rich, off of their hard work and salary at paychecks. But that's kind of like how things have kind of transitioned over the years. And then of course, as we also see some institutions, what they'll start to get into is more on the preferred equity side. You don't make as much, but in terms of a risk adjusted return, a lot safer than being in as an LP on the common equity stack side. So depending on what investors are looking for, everybody's looking for different things. And also within their portfolio, you have different asset allocation mixes. An investor who might be aggressive might be doing 30% into developments, 50% to value add multifamily, but still allocate 10% to preferred equity for that consistent, stable cash flow.
Yeah, and maybe if you want to just dive a little bit into what the difference is there between preferred equity and just your standard LP equity.
Yeah, I'll maybe explain it a little bit differently from a different point of view, as opposed to what you'll see in Quora or if you Google it. But like when we started to do deals, larger deals, we would have institutional partners come in. So if we would buy like a 300 unit apartment complex at $100,000 a unit. That's a lot of money, right? I think that's like 30 million, right? And we would probably need to come up with, $10-12 million for an equity raise. At that time, we couldn't raise as much as we did now, but we would bring in maybe $8 million from our investors, but then we would bring in a preferred equity piece who wants less. And in the beginning, I was a little like, it was kind of a head scratcher, right? Like, now I was not born in this world of private equity, but I was like, well, why the heck are these big institutions or family offices or supposedly smart money taking less returns? I get it, they sit higher on the capital stack, but is it really worth it that much? And as I started to learn and realize that, when you sign the contracts, and it almost works its way out to be sort of being a pseudo JV agreement with that institutional company. And boy, do they have a lot of legal protections when they work deals with us. And I started to realize that, there was a whole bunch of players in this world that love to just get focused on preferred equity all day, any day. It's the kind of the retail, unsophisticated LPs that kind of chase after the higher returns, the 14-17% IRR supposedly on the common equity side. Now, don't get me wrong, if you're under $2 or $3 million net worth, so we train our investors, you kind of have to do it, right? Like, sure. Institutional partners, family offices, they're typically, they've got a bankroll of maybe 50, 100 million plus. So it's different game, different like zone. And as I explained to my investors, funny thing happens when you pass over $4 to $5 million net worth, because as a family, at that point you can live off the 4% rule and do pretty damn good, right? You can cash flow and chill, as we say. But a lot of these preferred equity institutional investors, family offices, they've much more surpassed that point. And they also, again, like I said, when they work agreements, they have all these protections in place. And as I read these things and the lawyer's trying to explain what this line is for, that line is for, I'm like, wow, this is actually a pretty sweet deal, which is why we started to turn into a preferred equity lender ourselves, right? To kind of get involved in that game, at least in that kind of asset allocation mix side. So we've got different buckets, right? This world of investing, you learn something new every day, and it's always, from what I've remembered back in 2014, 15, I mean, 2012 was my first year I saw syndication. I thought this was a Ponzi scheme. And like most investors out there, I didn't know any accredited investors. I didn't have a rich uncle. I didn't, how do I get into this game? How do I make sure what's legit and who's real, right, in this world? And that's what I keep coming back to is like, building relationships with the real passive accredited investors is kind of the name of the game.
Yeah, for sure. And it's even then it's hard, you look at the environment out there right now, and even folks that, have had deals go full cycle, they may be faced with a little bit of turmoil just with, having to either refinance, or if they didn't, lock in their rate, that kind of thing. They're sort of riding those storms. But yeah, that's a great point.
Yeah. I mean, it's right now is the time to kind of get in, right? Because multifamily real estate really gets impacted more by interest rates, which is a leading indicator of recessions. I mean, 2024, I think that there's going to be a medium to light recession 2024, but as soon as the interest rates go down, it's party on in the multifamily world. And so right now, a lot of the multifamily assets are undervalued, maybe about 10 to 15%. And if you can, again, we always try and seek out individual distress in the ownership group, right? So you can get a better pricing there. Those you just have to be patient and wait for. But yeah, right now is the time to kind of get in. It's the unsophisticated investor that is kind of going to wait till, that everything is clear skies and, after 2025 comes around. But again, like that's where I've taken the advice of people over $5-10 million net worth. But most of the guys who are saying, oh, just wait on the side and wait on the sidelines are those guys who are perpetually under a couple $1 million. And they never take risks and they never do anything. Yet those are a lot of the guys on those internet forums that are just doom and gloom and, just write doom and gloom stuff all day long. Like, unfortunately, you can't see what the dude's net worth is to make any distinction if his words are worth anything. Everyone's got an opinion, right?
For sure. And you don't know their experience. You don't know what they've been through in the past. I mean, you look at the Great Recession, you look at all these times really in history where there has been a little bit of a fumble, and it became the time to get in, like you're saying. And there's some huge gains that can be made. You can't really time the market for, what's truly going to be the bottom, and you just got to start getting in.
Yeah. I mean, I always tell people like, be careful what the economists say, because, they don't really have any skin in the game. They're just weathermen at the end of the day. I kind of follow what people who, like colleagues I know that have skin in the game. I mean, that's me. I mean, we've got a couple $1 billion of deals that are kind of riding in the water right now. There's nobody that knows what the hell is happening out there, more than the people out there with that many assets. And, then I use the information coming from industry newsletters. A lot of these are you pay to get access to, but a lot of these are, more catered towards commercial, outfits like us. And I think at the very least, try to figure out, and this is common in the podcast and YouTube world, right? Like you have an influencer trying to get somebody to do something and scare the crap out of them. So they use their affiliate link to buy gold from them, right? Like that's pretty classic. And it's important to understand and identify the difference between that type of news source and motivation versus one that, is already established and just putting out information based on data, and they're not really incentivized to paint a picture one way or the other. And those are more industry newsletters.
Yeah. What do you have any recommendations on the industry newsletters?
Yeah, I mean, I personally like ITR Economics. Okay, and you got to be careful. I mean, like the brokerages, they put out good articles. Like your big brokerage, like I don't know if I want to say who they are on recording, but like the guys who sell properties, right? Right. They may not be the best news sources, right? Like, I mean,
exactly.
Never.
They want the situation to look very nice.
Yeah. Or it looks like crap now, but it's coming up.
Right.
Like, yeah. I mean, I for those, I'll typically just flip the, you'll have like reports and you'll have like data where it's, you can't really paint a rosy picture or not. Like that's just kind of the raw data you can take. I think like there are also like lending brokers that will have similar types of things, but if they're similar to the real estate brokers where they're always trying to incentivize action and transactions. So like I said, those are kind of skewed there too. Although like Arbor is one. Arbor is a lending broker type. Somewhat, you would think that they would be incentivized for you to transact, but I feel like they're a little bit more neutral. They're kind of they're a direct Fannie Mae, Freddie Mac lender. I would think that they're a little bit better, but I think a lot of it is like take the raw data and do your own synthesis. But I think you also need to have, your feet in the water or be in deals and feel what it feels in indication if you're looking at a chart of Houston, Texas, where the rents have been going the last quarter or the last 8 quarters, right? That how it feels too. And that's what I've been trying to do in some of like my reports lately. Like I've been trying to, of course, like we have our target markets that, the rent increases and stuff like that. I report in a spreadsheet, and then I report some of the big things such as what is the interest rates, what is the movement, what is the GDP, what is the unemployment, and then also some other like more emotional factors that I personally feel, anxiety within the stock market and whatnot, some unquantifiable things. Because I've been doing this for at least a couple of years, doing it on a quarter by quarter basis. And when I realized even 3 quarters ago, I forgot what the hell I was thinking or feeling, more importantly, based on what things, and even I get caught up. I mean, maybe partially because I do it to myself because I'm in the news articles every day.
Sure.
And I kind of, lose track of things, and maybe I need to have more of a bigger picture. And that's my purpose for doing this. Look at it more from a quarter standpoint and normalize my emotions and my sensitiveness of the data and how my assets are doing based on that semi-higher level view on a quarterly basis. And then, how is it historically based on where I've been in the past? Because who would have thought that interest rates would have went up, but the signs were there. The signs were completely there.
Yeah, for sure. For sure. I would have thought it would have happened a little bit sooner just based on kind of what was happening out there. So it's still hard to pin down even when you're expecting it, but it sure happened, and it happened, fairly quick. You mentioned markets. What markets are you focused on? Your fund is focused on. You said throughout the U.S. Are there specific areas that you target?
Yeah, I mean the red states. I think you hear this a lot, right? Because for landlord-friendly laws, and typically a lot of those. Then the next layer is more emerging markets where the population growth is increasing. Or, you just look at the rent increases data, right? I think the rent increase data is usually indicative of job growth and population growth. Those 2 factors. I mean, that's what makes real estate investing kind of easy. It doesn't take a genius for you to tell. I mean, I don't know which of the 2 leads each other. It's a chicken and egg thing. But at the end of the day, the data is readily available for rent increases, and that's typically the indicator of supply and demand coming online. So a lot of those markets are in the Sunbelt states, like Arizona, Texas, Alabama. We got out of markets such as Mississippi because of just the insurance has skyrocketed. People have been following the industry. Yeah, our insurance have probably sometimes even tripled. There were some also other reasons why we got out of the Mississippi assets, but yeah, your southern Alabama, your Louisiana, your Mississippi states, and your southern Florida and parts of Houston. That's really hard to get insurance out there. And it's blowing up a lot of people's performance at this point. But yeah, we try not to get too spread out too, right? Like for us, it like makes sense once you have like 1,000 units in there. It's kind of like a general rule. You have the teams that you can pull from other properties. And in case somebody is literally sick that day, you send the guy over. And also it works for even from a property management standpoint, the person can go over to the next sister property and help train and help out where it needs the most. Of course, all assets are kind of segregated in terms of accounting and stuff like that. But, there are synergies that can be made, to help out once you have more units. And then, at least when it helped us to get started was, once you get up to a certain number of units, that, you get to be known as more of a bigger player, and then you get the deals brought to you first. And that's kind of like where we are, kind of the bell at the ball a little bit. Like we have a lot of assets. So the brokers always try to be nice and it's kind of like, hey, well, give us good deals and you can sell our old ones,
Right.
Quid pro quo, man. That's the broker world. I know how you guys think.
Exactly.
I'm wasting my time. Yeah.
No, it makes a lot of sense. And what about, so are you in any other type of asset class besides multifamily? You mentioned development. What does that look like? What are you developing?
Yeah, we operate the apartments and the development partially, because we somewhat more vertically integrated with the building of apartments, because I think the problem that a lot of these developers run into is like they're sort of distressed sellers as soon as they build the thing, right? They're good at building stuff, but they're not the best operators and they're not really set up to do that. And, they create a lot of value, which is why we do it, right? We want to build stuff from scratch that they could really care less about operating it. But for us, if we can go to the lease up stage and get it 100% leased up, or at least have the option to do it, right? Kind of like running in football, wildcat offense. You can pitch to the running back or quarterback. It gives us options and ultimately leads to higher sales prices for us because we can be a little bit more patient and not just be desperate to unload it because we don't know how to manage it, which it's not us.
Right.
So those are kind of the two things we focus on. In the past, I've kind of worked with some other operation groups outside of what we do, mobile home park, self-storage. But, I kind of pulled back on that whole endeavor and kind of, for a variety of reasons, just haven't really found good people who say what they're going to do. And that's what's hard about this alternative investing world. There's just a lot of fake it till you make it people. And, it's really hard to find people that you trust long-term, from an LP to being a LPs, trusting GPs, or as I'm saying, even GP to GP, right?
Right.
Finding those partnership groups is super hard. And I've kissed a lot of frogs along the way. I've got stories. There's all kinds of stuff that happens behind the scenes within the cockpit of the airplane, which is the analogy we use for syndications.
Yeah.
And it's hard to find, honest people first, right? But then you also need competent people, right?
Right.
Luckily, I know I'm painting a pretty dim picture, which I think is the reality. And I think investors need to know about it. But, with real estate, luckily the thing kind of runs itself,
Right.
It's not like a tech startup or some new business venture capital thing where it's heavily, heavily dependent on the people at the top, the operators. Sure, your operators, your jockeys are very important. Don't get me wrong, but it's not to the extent in some of those more operational businesses. And I think that's why initially, and even when I transferred my whole portfolio to syndications and private placements, that was something I always kind of felt good about. At the end of the day, there's this real hard asset, and that asset provides real utility to real people of a growing demand population.
Yeah. Makes sense.
But yeah, I mean, mobile home parks, I mean, it's a lower end clientele. It really is class C and D. The whole thesis or the sales pitch is, like you're getting the best of the class D people, that don't want to be in close quarters of apartments. But what I realize is tough about mobile home parks, and a lot of people don't realize, it's actually a more complicated business than apartments, because it in a way, it's also a used car dealership too, operation, because you got to sell those units. I never mobile home parks, right? Like,
yeah, the
you got to sell those things. Yeah, trailers. I don't know if that sounds as good, but mobile home parks, yeah. So
that's right.
You got to sell those damn things. It's not like apartments, or it's like, all right, give us a deposit, you're in, right? There's this whole process before getting somebody in. And then, self-storage. The thing I don't really like about it is like, it's so easy to kind of get into and construct. And when you take over an old asset, you have to turn into class A so that, the people can go at nighttime, and you got to install the tech, right? You can't have a class B or C self-storage. You have to turn into class A, which is different from, we'll buy class B apartments, and, that's just, it serves that portion of the, the economic demographics, right? For sure. Not everybody can afford $2,000 a month in rent. So that's what it serves. But in the self-storage world, you don't really have it, because everybody kind of wants the nicer stuff. So that the problem arises is when a direct competitor decides, let's build a self-storage facility across your street, because it's too hard to build an apartment. That's a lot harder to build. And now they're competing directly with you. Where if somebody built a class A, like we just bought a property in Phoenix, probably 1970s, probably more class C plus type of vintage, but there's a brand new class A next to it. That actually helps us, right? Because that for sure it's a little bit nicer area, and it pushes the rents up, and it actually helps us. But if we were in the self-storage world, that would completely suck.
Yeah, for sure. And it seems like that happens more times than people would want to see. I mean, I personally can't believe how many of them speaking of San Antonio here, but how many of them are going up, it's like, how many people are going to need to store their stuff? And I mean, I guess it's still working, but just seems like, seems to be overdeveloped a little bit.
I never understood it. Like I maybe rented a self-storage unit once in my life when I was living nowhere, right? When I moved out, I had a little like 5x5 or 10x10 for $100 a month. But other than that, I don't really understand the business, and I don't really believe in the whole need of it. It's like, and I was looking from a perspective of like, all right, what happens when things go wrong, right? There's a recession. Are really people going to keep paying their $75, $150 a month? Because the whole thesis is like, well, it's like your Planet Fitness. You'll keep paying the damn thing because it's like so cheap, right?
Right.
And I'm like, I don't know if I get on board on that whole idea. Right? You might just dump your locker, and then, it's like, well, I lost my job. Let me just clean up my stuff around my house and stop buying crap from Amazon. And let me just cancel that, save $100 on my self-storage locker. I don't know, right? I don't know.
Yeah. Well, I think there's something to be said about that. I mean, if somebody has a choice, or they only have a certain amount, and they've got to invest it, or they've got to make a payment or on a bill, they're going to probably choose the roof over their head before, some storage unit that they got a bunch of their junk in that, just isn't, it depends on what's in there, I guess, but
yeah. That's a separate business, right? They just outsource, contract all that storage wars stuff out, right?
Exactly.
But yeah, like you could knock every asset class out there, like
for sure.
An industrial, right? Like, I mean, office, that one's getting beat up enough. We don't
for sure.
Office. I don't think office is, I'm not going to invest in office right now, but like industrial is doing good, but like who knows if Amazon makes some crazy way to condense the supply chain where you don't need all these warehouses anymore. Not saying that's going to happen, but I think like you got to look at everything you invest in and say like, hey, how can this be disrupted in any way, shape, or form? And that's why I keep coming back to apartments. Yeah. Unless the government turns into like China or something and starts to create all these like tenements and projects, like I don't see how it's really going to hurt the industry, like the asset class. Again, the problem I think it lies in a lot of people do it, right? There's a lot of competition pushing up prices, but as far as like breaking the asset class, I think it's kind of, I don't really see it, right? Or, I mean, I can talk about the benefits all day long, but look, I got a lot of money in that, so I got skin in the game.
Right.
For what it's worth.
Absolutely.
I sure hope I'm right. Right.
Well, people have always got to have a place to live, so I think you're onto something there, Lane. So
yeah. Often the most boringest investments typically are the best. And as much as I like to get into like waste management, which is one of the most boringest investments out there.
Yeah.
I can't because typically a monopoly in your local area and that type of stuff. But
sure.
We'll stay with this.
Absolutely. Well, what do you see for simple passive cash flow in the future? Just continue to kind of keep doing what you're doing, continue to find those opportunities where rents are increasing. And
yeah, I mean, just kind of waiting around. Like to me, I always have to invest. So just kind of look for the best stuff. I mean, not looking for the crazy home runs, but just keep investing in these boring asset classes where the story makes a lot of sense in the long run. And diversifying, right? Like one of my guidelines I tell my folks is never want to put more than 5 to 10% of your net worth into any one project. Right. You never know what's going to happen. And, I think one thing that we've learned from the past couple of years, right, is, you never know when a black swan event is going to happen, like interest rates skyrocketing, how it did. If more times than not, this black swan event will never happen. And you're going to be that sorry sucker who didn't do anything and missed out on the next best bull market, right? Like you never hear from that dude, right? He's still broke and nobody hears that guy. Nobody knows, nobody cares because you don't have money because he didn't play. He didn't play at all. But yeah, I mean, you just got to continually I call it dollar cost averaging, right? Like the investors that kind of got stuck in those particularly floating rate deals, late 2022, got kind of hit. But if you are like a more sophisticated investor, you kind of just do like a deal or two a year or a few a quarter, right? You spread it out. And it's no different than making wine, right? You make a vintage every year and you spread it around. I think 2020 had a lot of fires. That one's going to not be a good one and might be a lot of rosé out there, but the same concept, right? You spread around your net worth and you kind of, in the long run, you invest in the stuff that typically moves the right way.
Yeah, it makes a lot of sense. I know we're kind of running a little long on the time, and I want to be respectful of your time. I appreciate you being on. If you could maybe just let everybody know how they can find out more about you, where they can contact you.
Yeah, they can go to simplepassivecashflow.com. They can check out the podcasts. Just Google Simple Passive Cash Flow. We are also writing the new book, The Wealth Elevator. If you want to Google that, we'll probably move over the branding to that later on in the year. But I think something you said earlier, kind of just mentioned, you got to diversify into the stuff that makes sense. But I think the biggest mistake that people are always kind of hung up on is you start in the pre-call, people are stuck in that traditional investment world, right? Like, I think that's the big thing. Like, they look at these alternative investments, they hear the stuff and actually are aware of potential problems, But I think, unfortunately, it kind of freezes people to stay exactly where they shouldn't stay, which is those damn traditional investments that have high fees. Everybody's taking your money in the middleman. I think, and I think if you're a rental property owner, you kind of understand the whole thing, how it's the whole Wizard of Oz, right? Don't pay attention to the man behind the curtain.
Right. Yeah, exactly.
But that's the problem, and I think most investors who, listen to these podcasts, they typically jump in with maybe 10, 20% of their net worth the first 2 to 5 years. But after that, your deals go full cycle. You get proof of concept. You figure out who you like. You got to push it up to 30, 40, 60, 70% or more. If not,
makes sense.
You're not going to really hit your goals.
One thing we didn't talk about, and just really for the listeners, what about minimum investments, that kind of thing, when it comes to investing with your company?
So the way I answer that is like, people need to understand that they're big, large institutional private equity companies. These are, you're not going to get the highest returns from those guys because, they're big companies. They got a lot of overhead. They're well established. They're reliable. But, a lot of those minimums are typically $250,000 to $1 million plus, right?
Okay.
Probably for most investors, probably like, shoot, that's too rich for my blood, right? Now, most people in like I call it the middle market world, under $1 billion or a few $1 billion of assets under ownership, typically the deal minimums are like $50,000 to $100,000 in size. But I think the hard part for investors out there is like trying to figure out, well, am I working with a big institution? Somebody who's got a good track record, got some good assets under management numbers, and who's the new guys, right? That's the hard part for investors to kind of realize. But going back to your question about the minimum investment size, it's typically, aligns with like how established a company is at that point. Because normally, an investor, if you're an operating group, and I'm just going to say it from our point of view, you want to get away from the smaller investors. At one time, I would accept sub, $35,000, $25,000 minimum investments, but we realized a lot of those investors, they don't have very much money, which is why they're giving us short change there. And they also are the most like, emotional investors too. So yeah, like we don't really, and there's kind of a magic sweet spot somewhere between 50 and 100 grand that, most private equity companies like us we kind of like to stay in, because at least we stay. It's kind of like Class A tenants, right?
Right.
No longer,
yeah, no, that makes a lot of sense. I've heard that from just so many people about, the smaller the investment, it's actually the customer that's, calling you, asking you how things are going. It's a lot more maintenance for somebody who, it's most of what they have. Yeah. So
I think what folks like about me is like, I'm transparent, and I'll say, yeah, at one time we were desperate for money. We, trying to build a dream, build a business, and bring investors along on the ride. And if it meant taking a $25,000 check, a while ago, then so be it. But, those days are kind of behind.
Yes.
At least, yeah.
Makes sense. What about, Elaine, do you have any tips, any, I wish I would have done this sooner type of thing? Anything for somebody who's, maybe they have invested, like we talked about at the beginning of the show, maybe they've invested in stocks, but they're considering these other options, these other hard assets that are out there. What advice
is try and fill your network with purely passive investors, because the stuff that you hear from your compadres at work are going to be stuck at work for the rest of their lives. It's very current. They're going to be like, oh my God, you're taking a HELOC out to invest in real estate. That's crazy, but I think I think that's what I kind of work with investors on an individual level with, is like, we look at where's your lazy equity, and I call it the lazy equity witch hunt, right?
Yeah.
all the stuff that's making you under 5%, that's the stuff that's got to be invested first. It's not like, some people have stuff in their retirement accounts or maybe even have rental properties. And they think, I'm going to reallocate that to syndications. And I'm like, well, no, go look at the stuff that's doing the least for you first. Get that stuff working. And a lot of that stuff is typically in people's homes, right? If you have more than 30% equity in your house, you got to tap that equity because that's the laziest equity of all. Mm-hmm. And then, this very much clashes with like the Dave Ramsey, Susie Orman world. Once you get past a certain level of financial literacy, sophistication, you have to go into a lot of good debt to buy more assets, to cash flow and grow your net worth safely that way.
Right.
Most people have the financial literacy, very poor financial literacy, right? Most people spend more than they make. They don't make that much money to begin with. And therefore, that's why they follow Dave Ramsey, Susie Orman, or all these kind of personal finance blogs out there. But, I think if you're listening to this, there's a different world. And again, you got to try and find those types of people to get around because it is truly a mindset on this stuff. But look for the lazy debt equity, and that's in your primary residence, like more than likely.
No, I think that's great advice. Lane, I appreciate it. I think you've brought a lot of value to the audience. You've certainly built an amazing business, and I appreciate you just taking the time to be on the Wealth Flow with us.
Yeah, thanks for having me. Thanks, Keith. All right, everybody. Bye.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.